Look at standard corporate accounting. Its architecture is built to answer one primary question for investors: how efficiently is management deploying capital to generate profit? But apply that same architecture to a sovereign state or a public sector entity, and the math breaks down. Governments do not exist to generate a return on equity. They exist to deliver public services. This divergence is rooted in how governments actually fund themselves, primarily through what accountants call a non-exchange transaction. In a corporate exchange transaction, value is traded equally, but in a public sector non-exchange transaction, like paying taxes, that payment yields no direct proportional return. This broken feedback loop means individual taxes rarely equal the exact value of the benefits personally consumed. Because the funding is compulsory and the ultimate objective is public welfare rather than financial return, standard corporate metrics like net income or earnings per share fail to measure a government's actual success. To evaluate a public sector entity accurately, we have to discard the corporate model and rebuild our accounting logic from first principles. We need a system engineered specifically to measure democratic and financial accountability. The International Public Sector Accounting Standards Board, or IPSAS, solves this by constructing a conceptual framework. We can trace their logic tree starting from the ground up. This graphic shows the foundation of the public sector environment. The first structural pillar is that dominance of non-exchange transactions we just mapped out. The second pillar shaping this environment is the approved budget. A corporate financial forecast is just a projection. A public sector budget is a strict legal mandate. It represents the explicit legislative authority governing exactly how resources can be raised and spent. The third pillar is the nature and purpose of public assets. Governments hold assets like national heritage sites, highway systems, or military hardware for their service potential. They own them to deliver services to the public, not to generate cash flows. Because there is rarely an active market to sell a specialized military base or a national park, these assets require entirely unique valuation metrics. When an entity operates on compulsory taxation, strict budgetary laws, and non-cash generating assets, a traditional profit and loss statement is the wrong tool for the job. Once we establish the environment, the next logical step is identifying the audience. Who actually consumes a government's financial data? The IPSAS identifies two primary users for what is called the General Purpose Financial Report, or GPFR. The first group is service recipients. These are the citizens and eligible residents who rely on the state for public goods. The second group is resource providers. This includes taxpayers, but also multilateral donor agencies and sovereign bondholders who supply the capital. Unlike an internal corporate manager, a citizen or a foreign bondholder does not have the legal authority to force a government to generate customized, special-purpose financial reports. They have to rely entirely on the public data. That dependency dictates the entire objective of the reporting framework. Both groups require the data for two specific reasons: accountability and decision-making. Decision-making covers the actionable choices, citizens evaluating the data to inform their voting preferences, or lenders analyzing it to assess sovereign credit risk. Accountability is the obligation of the state to demonstrate exactly how it managed the resources it was entrusted with by the public. Therefore, the GPFR is engineered to fulfill this dual mandate. It treats long-term accountability as the supreme metric, elevating it over whether the government simply ran a short-term financial surplus. If accountability is the primary objective, how does the physical structure of the financial report need to change? Look at this diagram. A standard balance sheet, income statement, and cash flow statement sit here at the core. But for a government, these traditional metrics only provide a partial picture. The IPSAS framework expands the reporting boundary outward to capture 3 additional datasets. First is budget compliance. Because the budget is law, users need to see the variances between what the legislature authorized and what the executive branch actually spent. Second is service delivery achievements. A government reporting a massive budget surplus isn't necessarily successful. If they achieved that surplus by failing to fund the hospitals and schools that justified the taxation in the first place, they failed their objective. The third expansion is prospective financial information. Nation-states generally exist in perpetuity. When a legislature passes a new pension program today, they are making a commitment that will last for decades. Prospective financial data models the long-term sustainability of those decisions, measuring the exact financial burden that current commitments will place on future generations of taxpayers. The reporting boundary is intentionally broad. By mixing financial, non-financial, and future-oriented data, the GPFR captures the actual long-term impact of sovereign decision-making. Pulling perspective and non-financial data into a formal financial report introduces a clear risk. Subjective estimates can easily be manipulated by political actors. To prevent this, the IPSAS framework institutes a qualitative filter. Every piece of information must pass through these 6 gates before it is allowed into the GPFR. The baseline traits ensure that the data is relevant, understandable, timely, comparable across different jurisdictions, and rigorously verifiable by independent auditors. But the most critical gate is faithful representation. Faithful representation dictates that the data must depict the true economic substance of an event, rather than just its technical legal form. This gate is driven by 2 subcomponents: neutrality, the absence of bias, and prudence. In the 2023 conceptual update, the board heavily emphasized prudence, defining it as the exercise of extreme caution when making judgments under conditions of uncertainty. The rule is absolute. A government cannot overstate its assets or revenues, and it cannot understate its liabilities or expenses. These specific filters strip away political spin. They prevent governments from obscuring future fiscal cliffs and ensure the resulting data serves as a rigid, neutral tool for public accountability. If we pull back, we can see the entire architectural logic of the IPSAS framework we just built. Step 1. The non-exchange environment dictates exactly who the users of the report are. Step 2. The user's reliance on the state dictates that accountability is the primary objective of the reporting. Step 3. That objective of accountability mandates an expanded reporting boundary. And Step 4, that expanded scope requires strict qualitative filters to maintain the integrity of the data. Public sector accounting is a distinct discipline. You cannot solve a sovereign state's financial reporting by simply crossing out the word corporate on a balance sheet and replacing it with government. By adopting IPSAS standards, governments abandon fragmented reporting for a rigorous, mathematically verifiable system. It gives citizens, sovereign lenders, and global institutions the exact data they need to assess a state's true long-term solvency and its actual operational effectiveness.